Hello and welcome back to Money Never Sleeps. My name is Bob Cruces from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. Today, I'm going to talk about taxes and the power of when. If you don't know what that means, stay tuned, as I'm going to explain it. Before I do, though, let's take a quick look back in history at Al Capone. In the 1920s, Al Capone ran a wide array of criminal enterprises in the city of Chicago, ranging from gambling to protection rackets and everything in between. The FBI tracked his crimes for years, but when Capone finally went to prison, it wasn't for any of his most notorious violent crimes. He went to prison for tax evasion. I'm telling you this story to illustrate a point. You cannot avoid paying taxes, and you won't get anywhere by trying. But you do have some control over when you pay taxes, and that flexibility can make a difference for your retirement. So how do you harness the power of when? It starts with understanding how different products and accounts are taxed. Typically, they fall into two different buckets, tax now and tax later. CDs and non-retirement investment accounts like mutual funds fall into the tax now bucket because you fund them with money you've already paid taxes on. The taxed later bucket includes things like traditional IRAs, 401ks, and 401(b) accounts. You make those contributions with pre-tax money, which reduces your taxable income. But when you withdraw the money, it's taxable. Fortunately, there is a third bucket that you can set up for yourself, and that's the tax-free upon qualified withdrawals bucket. Roth IRAs and some life insurance policies fit into this bucket. You'll fund them with money you've already paid taxes on, but withdrawals and loans are tax-free as long as you follow the rules. What is tax diversification? Tax diversification means you have money in accounts that are taxed differently. To help illustrate how tax diversification works, let's look at a couple of scenarios. In scenario 1, 70-year-old Emma has a total income of $37,000. $24,000 from Social Security and $13,000 from a pension. She needs a new roof, which will cost her $15,000. She takes $20,000. She has to take out $20,000 so she can cover the taxes from a traditional IRA. From the perspective of the IRS, this is ordinary income, which means she'll have to pay taxes on the withdrawal, and it may increase the taxes on her Social Security benefits. But what would happen if Emma borrowed $15,000 tax-free from the cash value of her indexed universal life insurance policy? The IRS would not consider the loan ordinary income, and she would not have to pay any additional taxes. It's important to remember loans are not usually subject to income tax unless the policy is classified as a modified endowment contract under current Internal Revenue Code regulations. Since Emma put her money into diverse buckets, she had flexibility when she needed it most and minimized her tax bill. Note, in this hypothetical example, Emma purchases an indexed universal life insurance policy at age 60 with 5 payments of $20,000 each. Loans and withdrawals generally decrease the death benefit. Life insurance policies typically require health underwriting and, in many instances, financial underwriting. Let's look at another scenario. At age 40, Jeremy opens a traditional IRA. He contributes $5,000 to it every year for 25 years. Because it's a pre-tax account, he doesn't pay taxes on the contributions he makes, though his tax rate is 15%. His account gets a rate of return of 6%, and by the time he reaches age 65, he has $290,781. He plans to start taking withdrawals at age 70 and wants the account to last for 20 years. Now, the thing about taxes is that they can change. It's possible that taxes will stay the same when Jeremy starts taking his withdrawals. Jeremy will pay ordinary income tax since it was funded with pre-tax money. Taxes could go down, but they could also go up. And in this scenario, that's exactly what happens. By the time Jeremy is 70, his tax rate is 25%. So, let's say Jeremy has $389,131 by age 70. He takes withdrawals of $32,500 each year at a 25% tax rate. If he takes no action over the next 20 years, he'll have paid $160,029 in taxes and received $480,060 in net income. In another scenario, Jeremy converts his IRA to a Roth IRA. He converts the money over time, but before the tax rate goes up. Because Roth IRAs are funded with money that's already been taxed, he pays taxes on the money when he moves it to the new Roth IRA account. Then, when he makes qualified withdrawals, he can do so tax-free. By age 90, he has paid $58,370 in taxes, paid at the time of the conversion, and has received a net income of $544,100. If Jeremy opts for a Roth conversion, he ends up with $64,000 more in after-tax income. In addition to helping protect you against future tax increases, tax diversification can offer you some certainty in knowing that you have access to tax-free income in retirement. Knowing you have money that won't be subject to tax hikes can help make it easier for you to plan with more confidence. Roth conversions and life insurance policies aren't the only strategies you can use for tax diversification, and they aren't right for everyone. A financial services professional can help you determine which option will best help you work towards success in retirement. Other things you may want to discuss with a financial services professional include Social Security taxes, the last dollar strategy, and the widow or widower's penalty. That's all the time I have for today. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.